Hello, everyone, and welcome to DFW 2401. This is week 2, and we are talking today about the risk matrix of the bank, and that includes all the risks, but we will only define them in part 1 to part 3 of this recording. From part 4 to part 6, we will talk about the interest rate risk, which is the first first risk that we will talk about it in details. So if you allow me to share my screen now, this is how it looks. So this is the risk matrix, which we'll talk about it in the part 1 to part 3. And this is actually coming back to our main model of this banking, and I think we have talked about it before. And we talked about the all those risks because of the intermediation issue. You can talk about credit risk, market risk, liquidity risk. All of those risks are there, and to buffer those risks, we have to have some management and control in place, which is the management of those risks in the banks. For example, in credit risks, we have to take all those measures to decrease credit risk. If you talk about liquidity risk, we have to take also all measures to control liquidity risk, and so on and so forth for all those risks. Now, how that management is working, we will talk about it in each week when we come to that point. But this is the whole concept. Now, as you can see, all those risks, inherent risks in the operations of the intermediation, will be coming to the management. Management will try to manage them, but sometimes we will not be able to manage all those risks. And there will be unexpected risk that we didn't take care actually, and are not able to manage them. So there will be some losses. Those losses will go to the second buffer, which means the spillover now of the risk that cannot be managed because they are unexpected, they will go to the capital. And the capital will try to absorb those losses. And this is actually the purpose of the bank capital, is to buffer the losses. But sometimes, like what we have seen during the financial crisis, the Asian financial crisis, or the global financial crisis, or any other crisis, if the losses is too much to be absorbed here or here, then the bank is actually will be bankrupt, which means if the losses eat all the capital and all the eat all the provisions we have done here to manage them. Having said that, I think we have talked about this, but we divided our unit to be like this. So you can see each week is actually taking some type of risk. For example, in week 1, we talked only about the specialness, which is here. Then now, the rest of the weeks actually are between managing the risk, or talking about the risk management tools, or talking about the regulations, and the weeks are divided according to that. Now, today, we are going to define most of all those risks, but then in the weeks that will come, we'll study not all the risks, but most of the risks. We'll study them in details, where we can define them, introduce the management tools, and measure them. So today, as I told you, we will actually study this risk in part 4 to 6 of this recording. And also in the slides, we will talk about the interest rate risk. Having said that, I have divided today. So as this, so the first part, which is actually part 1 to part 3, and this recording, and also in the slide, we will talk about those risks in terms of defining them. And then in the second part, we will talk about the interest rate risk, which is in terms of manage them, the models that been involved in this. So that actually will be part 4 to part 6 of this recording, and also the slides that have been uploaded for you. They are divided from part 1 to part 6, and it takes this flow. Now, actually, I tried to summarize all those risks in this to mind map your thinking. And if you want to look at any risk, this will give you a full picture actually about the unit, but you don't have to memorize anything. Just if you can go over them, you will see all the definition of all those risks. So we have, as you can see, interest rate risk, market risk, credit risk, what do they mean? Of balance sheet risk, so on and so forth, until we reach to other risks, which is the integrated risk of most of those risks. Now, this is all, as I told you, the bird eye to look at this, to look at the whole picture, but you can just scan it and it's actually useful for you to follow. But the definition of each risk is here, and then some explanation about those risks is coming here, and you can look at them maybe later on after you studied all the risks, or maybe you just take a general idea now. Now I will start with part 1, and part 1 I want to talk about market risk. Why I didn't talk about interest rate risk? Because interest rate risk, we will take it from part 3, from part 4 to part 6 of this recording. So I'll just start it here for the definition of those risks and part 1. So let's talk first about market risk. What is market risk? Just as simple as this. Market risk is actually the changes that will happen in the market in its holistic base and holistic sense, change in the exchange rate in the market, or the interest rate risk, or the equity market, which we call them asset prices. This is the equity market. Now, this market risk, which is happening in the market, actually will impact also our interest rate risk as a bank, foreign exchange risk, and liquidity risk. And I want to introduce you now to 2 main concepts called the trading book and the investment book. Now, just to make it like this, if I have a loan that I will keep to maturity, now this loan is actually, if it is up to 25 years, for example, then this, and I will keep it to maturity, then this loan is actually coming under the investment book. But if I am trading in the market using buying stock, bonds, derivatives, commodities, all of those, and I just acquire them in order to sell them in the next auction, like I can take them for 1 week, 1 day, few hours, intraday trading, we call it the trading book. So based on this, the market risk can come to the picture. So the investment book is actually long-time holding, while this is a short-time holdings. Now, market risk has been a very, very big problem for many banks that have been collapsed before. I think if you click on the Bearing Bank, we have a case. You can look at this. I give you the link here. This was trading here in Singapore, and actually the trader of this bank was highly involved in derivatives and was actually working with the Japanese Nikkei stock market index. I think he was trading and involving in high derivative contracts to bid on that market. And actually, there was huge losses where the losses actually coming from this operation and the market risk had led to huge losses. Actually, it was 1,500 million, but the capital of that bank was only 800 million, so the bank collapsed. This is just to give you an example of how the market risk can be very, very risky if you don't take care and manage it very well. This will give you even better picture. Look, this is the investment book, which we call it the banking book. In the asset side, you can see we have the cash, the loans we will keep to maturity, and then we have the fixed assets. But earning assets, for example, we have the loans. And the deposit sides, we have the capital, which is our capital, and other deposits. And then we have the liquid borrowed funds, which means we borrow from other banks or from the central bank. Now, this is actually we hold to maturity, which is this part. But the trading book, which is this type, we can go and buy bonds, and we call it long in this case. We can buy liquidities, commodities like oil, like steel, like sugar, like wheat, and European banks actually do a lot of things. And we can buy foreign exchange, and we can buy equities, and we can buy also derivatives. Now, let me just say, maybe you noticed that we are talking about long. This is a term we use it actually in finance, and long means you buy now because the prices are, you buy now because the prices is less, and you sell in the future. So if you buy bonds now and their prices is low and you expect them to be going up, so you hold them for some times, 1 day, 1 week, whatever, until the next auction, and you sell them with higher price. Now, the opposite can happen, which we can have bonds. So actually in the bonds, we sell now because the prices are high. And then we wait until the prices go down and buy them again. And how these things happening? Actually, brokers provide those facilities. If you see the prices now are up and you expect them to go down in the future, so you buy now, you sell them now, and then when the prices goes down later on, you buy it again. By why it is liabilities? It is liabilities because now when you buy in the future, actually you borrow it now. So your broker will provide you with those facilities and provide you with those bonds and commodities or whatever. And in this case, it is a liability from you to your broker. This is the easiest way to understand it. So he will provide you with those liabilities. You sell them now, but you still have a liability towards the people like the brokers who provide you with those funds. So you buy them as a liability, you sell them now, and you wait in the future, you buy them again, and you give those assets back to the people who provide you with those liabilities. And in this case, you make a profit between the selling of now and the buying in the future. Now, this is how the short works. We are done with the market risk. as a definition, let's talk about credit risk. This is one of the risks that we know it very well. So most financial, this is actually the core of the financing, because and even the asset transformation is very clear when we talk about credit risk. And actually we take deposits and we make it loans. So we take a deposit and we make it loans. Now, the problem with this is we have two types of risks here, which we call it limited upside risks, which means now principal and interest payment. Upside risk focus on uncertain positive return rather than negative returns. So we have limited upside risk and large downside risk. I think this, you know. So large downside risk is actually the defaulting. So if you don't receive your money or of the principal or the interest or both of them, or they are delayed, like non-performing loans. Non-performing loans is actually delay of the payments. If this is happening, this we call it the large downside risk. But we have another one, which is limited upside risk. Maybe this is a new concept to you. And actually the principal, the interest, it focuses on the uncertain positive return rather than negative returns. In other words, just look at this example. If you buy now, if you invest today in some of the stocks and bonds, and you decide to sell them today, and you did sell them in lower prices, but then the prices in the future goes up. Actually, you miss this opportunity by holding the assets till the future and until the prices goes up. And because the difference between selling them now and not waiting to the future and the prices goes up is actually, we call it upside risk. And finance, they call this upside risk, and they consider it as a credit risk. It's a very, very rare case, but they mention it and they actually state it as upside risk. It's very strange a little bit, but actually this is how upside risk works, which means the opportunity of selling your asset in the future of higher price, and instead you sell it now with lower price. That's all about it. Now let me go down back to credit risk. So we have two different types of credit risk. It can be from the firm-specific credit risk, and this can be managed by diversification, or it can be coming from the systematic credit risk, which is we cannot even use the diversification here. Now, firm-specific credit risk affects particular company, but the systematic credit risk affects the borrowers. Let me make it easier for you. During the financial crisis or the Asian financial crisis, we actually have a systematic credit risk. A systematic credit risk when it was a credit crunch, when the market actually collapsed, people who were doing well, but for example, you will have so many businesses who are taking loans from the banks, but because the market default, the whole market collapse, and those businesses are actually not able to generate cash, and because they are doing less sales. Just think about the COVID. So many industries like tourism, like hotels, all those recreation places, actually they had loans, but they default to pay. And not because they have problem in the company, but because actually there was a problem in the market. Airlines was a very big example. What happened to AirAsia and Malaysian Airlines in this country, because there is rough lights, not because the company has problem with its sales and not collecting. So this is what we call it specific credit risk. Now, actually systematic credit risk. Now, I think we have talked about this when we talked about unique. This is actually the one in the normal situation where we can control through diversification. And this is actually the market risk. And this is, as I told you, if there is changes in the interest rate risk, market risk, exchange rate risks that affect the whole market. So this we can diversify and reach to zero. This one will all the time be there. This what the diversification do to control credit risk or market risk. If you look at the credit risk, you can have so many measures like non-performing loans, and you can look at also bad debt. This is a little bit old data, which they take it until 2011, but as you can see, 2009 and 2008 and 2009, which is this area, is actually where the problem started. And this was because of the financial crisis. If you look here also, you will find it the same, especially if you are talking about 1991 to 2011. But actually, so this is non-performing loan is loan payments, and this is bad debt credit risk. Now, I also take this data, and I think I shared with this data with you in tutorial 1, and I take Maybank and Public Bank for the last 25 years, specifically from 1998 to 2020, and you can see the non-performing loans. Actually, this is for Maybank, and this is for Public Bank. It looks like Public Bank have this credit risk, non-performing loan, which is a measure of credit risk, but actually it was like less than the Public Bank, higher than Public Bank. What is 4? This is year 1, 2, 3, and 4. Actually, as you can see here, there was huge increase in 2001. But there is also the increase in 1998. This is the financial crisis. And then it goes down. If you look at this 2004, 2008, and 2009, it's actually in this areas when it goes up, these areas which the non-performing loans was there. Actually, Malaysia was not affected very much. I am done with this part. Thank you very much. And actually, I will see you in the second part. Thank you and bye-bye for this part.